is headed in the medium and the long term, though. We've got Vikas Kumar Jain, Head Research and India Strategist at CLSA India, joining in at the show right now. Vikas, hi, morning. Good to have you on the show as always. Vikas, the two-day GST meet kickstarts today. There's so much expectation from what's going to happen in the next 2 days. But why is the market ignoring it?
Well, I think we've been in a market which has now seen a lot of sentiment kind of cool off. It's been tough to find foreign investors who are bullish on India. I mean, that's a big change from, say, 12 months ago when end of September last year, our markets made a new high. It was difficult to find people who were bearish on India. It's kind of taken a complete U-turn. On the GST bit, I just hope that the event is like the initial expectations because, see, if it's a measured change, then, a lot of people, it's a few names that you can call this event for. Could it be a true GST cut event which pushes consumption? Or is it just a GST rejig event? I think how is the event perceived by the market can determine the move of the market going ahead. So, what I mean by both of those, if it's a measured change where you are trying to focus on the micro, say that, okay, some of these commodities move higher because, some of the news flow which came yesterday, that suddenly it's a little surprising that EVs, which should be a focus area, that some set of that EVs, which are possibly more expensive, will see an increase. Now, see, these are things there are enough arguments to say that, yeah, there is logical reason why you should do that. Perhaps those similar SUVs, the tax differential will still be higher, etc. But at this point of time, the jury is out whether the government is using this as a way to out and out push consumption and push domestic growth to offset any impact on trade-related, on growth due to trade-related issues. If that is the case, then it should be a broader statement that, yes, we are here to push consumption. If that statement is what comes out, after GST changes, the market is going to like it. It could be seen as a positive surprise. If it's a measured move that, okay, we are being selective, then, the reaction will also be selective as compared to taking an overall reaction. So I think that's where the jury is out. The market is going into the event a bit undecided, which actually maybe at times is not that bad, as compared to going into it with a lot of expectations.
Oh, absolutely. Because, that's on one hand. The need of the hour says that it should be a massive rejig. We need the consumption fillip, although the GDP data seems to be indicating that we're in ship shape. But that said, the foreign institutions have been completely out of the market, right? Be it this month's figure, last month's figure, as sizable as almost touching 40,000 crore rupees, or the previous months. Year to date, it's been a net sell and quite a huge figure. What is the big concern? Is it really about valuations? Because growth and hopefully now domestic consumption all seems to be taken care of.
Yeah, that's a fair question. But if you look at, the long-term India story remains quite promising. But keeping that aside, there was a period where India had its own kind of a bull market. Say, for example, after the correction that the broader market, that most markets saw post the October 21 high, India made a fast bottom around mid-2022 and had a rally. India was amongst the few markets, maybe other than the US, which was seeing a bull market of its own. Following events that have played out over the last 12 months, which is a combination of how perception of India, say, in terms of being a clear friend to the US and maybe being able to benefit through its friendship by both with the US as well as its historical relationship with Russia, which was a pretty advantageous situation. All of that is right now being questioned. In addition to that, there were other events which happened elsewhere, which suddenly brought interest back in China, and China's done pretty well. So all of this happening at a time when, in general, EMs are not seeing big inflows. There was a requirement that all of this last 2-3 years where there was a move in favor of India, let's that clearly gets unraveled. I think that's what has been happening over the last 12 months. If you were to look at the very near term, the kind of setup that we have, it's not something which is attracting a lot of foreign investors who have a shorter term focus on equity markets. And that, equity markets can have all kinds of participants. There can still be people who would just want to look at the 3-5 year story and keep investing in India. But there are still a significant chunk of investors who would want to also look at the near term. And near term, where China had become so cheap, it's just kind of coming off and racing from there. People can argue that there could be more over there. So from that perspective, there is very limited near-term excitement on India. And that's why events like, GST kind of a cut, which brings in the consumption push, perhaps more rate cuts by the central bank, all of that can suddenly bring back interest, even in the near term, that now India is able to fight back and offset some of the potential impact that people were fearing in terms of the geopolitics and the trade-related issues coming, is kind of coming against the story. So that's what foreign investors are kind of closely watching, in my opinion. The good thing is, through this period, we've seen EM funds and some of the global funds clearly cut their India weight. So it's difficult to find too many people who are overweight on India at this juncture. So at least positioning has become much lighter over this period of 12 months. At the same point of time, I don't know, good or bad, but the interesting thing has been, if you look at certain charts, India has had one of its worst underperformance versus the EM benchmark or some of these broader benchmarks in the last 20-30 years. It's like the third worst or something. But it has happened at a time where in all historical instances when this has happened, India also became a far cheaper market on a relative basis than these benchmarks. That's not yet fully played out. Yes, there was a point where we had become, our valuation premium was nearly +2 standard deviation versus historical average of where premium versus the EM benchmark was. That has come off well below +1. But we are still not, earlier instances have taken it well below average. We're nowhere close to that. We're still higher than average. Yes, versus China, we are coming near 15-year average premium. Still pretty high, but near that. So some of that is cooling off, but it's happening very gradually. And that's where it might, in itself, unless some kind of trigger starts becoming visible, that is going to be a little bit of a long-drawn process if it happens at this gradual pace.
Well, Vikas, very interesting points there. Morning, this is Shrishti also joining in. But to the point on GST and the EV cars that you were making, because the fact of the matter is, with respect to the GST rate cuts, the government finances will get impacted. And in order to compensate with respect to that, there could be some cases where the tax slabs are inched higher. EVs is one we'll definitely watch out for what the verdict is, or if at all we happen to hear something on that. But apart from that, help us understand any other sector where you see a possibility where this higher GST tax slab can be an overhang?
Well, I think it's not an overhang, but where it could provide a boost. Overhang as in where can it provide a boost? So most of those sectors like durables, autos, and select other, consumption spaces could benefit a lot if we get this kind of, if there is a GST cut rather than a rejig where there's some cut and some going higher. On your question on government finances getting impacted, yes, that's a fair ask. But I think now this is where, there can be no right answers to it, but there is a camp that you choose and a side that you choose. With all that has been thrown onto us versus where the budget was made in terms of, the tariff-related growth impact and a host of those other things, I think our priority also needs to shift a little bit. Whereas when the budget was made, the number one priority of the government was clearly to bring down fiscal deficit at a dramatic pace. So we talked of a 40 basis reduction in fiscal deficit as our target. Now, government needs to think that as the setup and India's setup within the global geopolitics has shifted, is it important to balance that goal a little bit with growth? Perhaps maybe give up on the target of fiscal deficit of a 40 bits YOY decline and maybe allow it maybe something like a 10-20 bits and use that to boost growth. See, I would favor that kind of a situation. It's perfectly understandable with the kind of growth impact that one has, that you become a little bit more growth focused and more balanced towards your deficit reduction targets. Because the setup versus when the budget was made has changed. So, we need to react to that changed setup, is my opinion.
Hi Vikas, morning. This is Snehi also joining in the conversation. Just want to understand what the portfolio restructuring, if at all you've undertaken, could be right now, given that Q1 earnings were not all that bad. We're expecting some more improvement in Q2 and also now on the back of these GST announcements. Any sectoral tilt in the portfolio perhaps?
See, in fact, the earnings thing that you brought up, I have a tactical opinion that somehow because of this GST change, the earnings of the upcoming quarter, which is the September quarter, will matter much less. And that's pretty well understood by the market because there has been some kind of a delay in sales because of the changes in GST, which is likely. And that is very well accepted by the market now. So at least from an earnings perspective, for a lot of these consumption-related plays, and even I would say some of the export-related plays, which could see an impact due to the trade tariffs, I would say the market has already digested that this will not be the best of the quarters. So from that perspective, it's the announcements and where these announcements could take us in the coming months, which should determine, the stocks and sectors that we should be playing. And here, like we were talking about the GST bit, if the final announcement comes out as out and out positive for consumption, then I think this becomes a crucial binary event where you start favoring consumption even more. Our current setup is where we have, since we don't expect a lot of significant absolute upside from the markets because it's still more expensive than global peers. Our setup, our favored areas are defensive sectors, number one, consumption, and rate sensitive. So those are the three themes that we are focused on in terms of how our positioning is. The question is that how does the event of today and tomorrow play out? If it is even more positive on consumption, then people should think of even doubling down on their consumption bets.
Yeah. I guess the next 2 days are going to define how, or rather how much positioning one would have in terms of consumption in their portfolios. But other than consumption, Vikas, what are your biggest overweights and underweights in the market right now?
Yeah, so just to kind of be more specific on what I said. So when I say defensives, staples, utilities, and IT are our overweights. Along with that, if you were to look at consumption, then autos along with staples falls in that bracket, and autos with real estate also falls in that bracket of rate sensitives, small overweight in banks, and more stock specific kind of overweight in energy. That's really how our India focused portfolio is positioned at the current juncture in terms of but again, some of these events could make us rethink and look at positioning even more closely if we have to change something, make it more extreme or change into another sector. I think some of these events could pretty much matter a lot.
Vikas, where does telecom lie here? I mean, I know the market is now really not about sectors. It's about individual stocks within sectors which are seeing leadership. But lots happening within the telecom pack, right? Hopefully you've got a third major player which is going to list perhaps soon. And then, of course, you've got the dominant leader, Bharti, wherein you're seeing the capex cycle actually slow down. That's something that the markets are liking. And now you have Indus Towers venturing into newer territories like Africa.
Well, I think when we talk of telecom, honestly, there are, since ours is a large and liquid portfolio, there are only 2-3 stocks to look at. At this juncture, we are playing it because there's a conglomerate that we have in our portfolio through that exposure. But things will obviously look pretty interesting with a very large IPO in that sector likely in the coming months. So that sector will, of course, be in discussions in flavor, obviously. So I think that's a sector which will be talked about quite a lot in the coming few months. And there will be a large stock which could also be listed pretty soon. So, I mean, the number of investable opportunities is going to increase in that sector.
Okay, so Vikas, that's your strategy when it comes to the entire telecom space. We've touched upon consumption, financials. Vikas, what's your take on the IT stocks in particular? Because even if you take a deep dive in the IT space, very recently, in the last couple of trading sessions only, we have seen recovery in both the large as well as the mid-cap IT players, and lots of announcements also coming in on this front. Do you believe this sector merits a relook now that we have more clarity on the tariff front?
See, I have to tell you that we went overweight IT a little bit ahead of when we should have, because it got impacted by the tariffs that India saw, which we were not expecting. So we went overweight IT 2, 3, 4 months ago. But our thought process is incrementally, we believe that the India-US tariff news flow, if anything, the worst has possibly already played out. And incrementally, if you see even our own Commerce Minister's comments coming out, and plus some at the margin comments from US administration, there is still chances of a deal which might play out over the coming months, which will only improve the situation incrementally. So all the export-related stocks might see some kind of a relief. IT per se, historically what we have seen is global tech generally does well when Fed rate cut cycle starts, and IT typically follows. And since we are talking of a Fed rate cut cycle starting in a few weeks' time, I think that should also have some kind of a positive rub-off over IT. It's a sector which is now at far more palatable valuations. And that's why we have a pretty out of consensus overweight on that sector. Mind you, it offers reasonable yields. Those stocks with their very clear capital return policies offer reasonably attractive yields as well.
Okay, Vikas, appreciate you taking the time out and joining us and sharing such insights with us and our viewers today. Thanks so much for your time.
Thanks for having me.
Thank you.